Welcome to episode 28 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I am Will Smith, here with my partners in Minds Capital, Max Lemus and Nicholas James. Today's conversation is with Rick Apple of Upside Growth Partners. Max, what did you think of our conversation with Rick?
So my favorite part of episode 28 is that Rick Apple likes our Minds Capital investment in doggy daycare. So when he mentioned that, I felt like we're pretty smart, hopefully, and that was nice. So no, but in all seriousness, he's an inspiring guy who is balancing raising 5 kids and managing 12 platforms. So I know he's got 8 active right now, but he's had 12. He's already exited 4 platforms very successfully. He talks honestly about how hard it is to be an operator and how many folks underestimate that, which I wholeheartedly believe. It's very difficult to manage and operate a closely held business for lots of reasons, including managing people and having imperfect data, budget constraints. It's just not as easy as it seems, I think, when you're looking down at it, maybe from private equity as an analyst. So he was honest about that. He mentions that that he and his group they find operating partners first sometimes, and then they go out and find deals based on the operating partners and their combined expertise, which I thought was interesting because it is so important to match the operator with the operation. And it is hard to be an operator, as he said. So I thought that was a very good tidbit there. And then he also double-clicked on the fact that having some early success as an entrepreneur can really get the flywheel going, which I thought was interesting and makes perfect sense. It gives you more capital to invest. It makes it easier to raise capital on future deals, and it gives you a track record. So, having that happen early on really gives you a lot of momentum, and that's clearly happened for Rick. And I think that's been part of the recipe for his success. Yeah, that was great. That line, everybody wants to be an operator. We heard him say that in the pre-call and pressed him for more in the interview. It was pretty interesting. I'll just comment on his trajectory. So I also thought Rick's career was interesting from the perspective of diversity. They've done everything from very early stage stuff, the Buford Bonnet story, his kind of first really big success, all the way up to now. They're doing more traditional kind of lower middle market private equity in businesses with EBITDA and the kind of the range and the sort of stuff that we would invest in, mid-single digit style. So a lot of variety in what they've invested in and kind of overall in Rick's career. Nicholas, what did you think?
Well, first of all, I just think Rick is a super smart guy. So Rick, thank you very much for coming on the podcast. It's inspiring. I learned so much, and just getting a masterclass from you like this is a real privilege for us. I enjoyed how he was so honest about their underwriting. He was, a base case for us on a down the fairway deal should be 5x MOIC. When you say that out loud, it kind of sounds preposterous that you're going to 5x your money in 5 years on any investment, frankly. But he said that for a typical buyout, they want to see a very credible base case where they can achieve 5x. And then he said their underwriting also will suggest 7x for the upside and 3x for the downside scenario. So I thought it was refreshing to hear that from such a seasoned sponsor. He did say in that same breath that when they start a new platform where the risk is much higher and the upfront work is a lot more heavy, then they look for 20x MOIC on those kind of opportunities. So really cool to hear that from someone who is so experienced.
I also enjoyed his transparency and honesty on the psychology of retail LPs and how high net worth individuals, right? The difference in psychology in writing a $100,000 check versus a $200,000 versus a $500,000 check, and how these are tiers, almost zone skipping in raising from retail investors. Punchline being that a lot of people can get comfortable with writing a $100,000 check. Rick characterized it even as they're just having fun. It's fun for them. Whereas go to 200,000 and certainly 500,000, but even just to 200,000 in the pool of people who are willing to invest that sort of money in an illiquid investment in the private markets goes down dramatically. Thought that was really good insight from somebody who's raised a lot of money from retail and high net worth. Well, before we turn to the interview, Max, you were going to share with us some of your observations on the data set that GF Data provided us as part of our new partnership with them. They gave us a sneak peek at their Q2 numbers. And Max, what did you find from some of that data?
Yes. So we get to have a look at the second quarter 2025 leverage report from GF Data, which is really interesting. And just to give you some background, to give all the listeners some background, so GF Data aggregates deal metrics from 334 active contributors, and those can be private equity funds, family offices, independent sponsors, SBICs, and mezzanine capital providers. So the transactions range from about 10 million in enterprise value to 500 million in enterprise value. So a big range there. So I'm going to start with some of the macro stuff and get into a little bit more specific here. So in 2021, the 334 contributors to GF Data contributed 500 deals to the database. So that was really the peak of when interest rates were very low. After the pandemic, there was just a ton of deal volume. Right after 2021, if you remember, interest rates began rising. Whereas they were at about 4.5% to 5% in 2021, they started rising to a little above 7% in 2022. And there was 333 deals reported in 2022, which is obviously a huge drop. 2023 was actually the dearth that we've seen in the last few years, with 295 deals reported to GF Data. At that point, debt rates for senior debt were in excess of about 10% on average. In 2024, we had 388 deals reported to GF Data. So last year, we saw a nice rebound in deal volume as interest rates came down just a bit, maybe to about 9.5% on average is what their data suggests. And then we've got data as of this leverage report as of the trailing 12 months into June 2025. And we're sitting at about 326 deals right now. So a little bit of a decrease, it looks like, from last year. Interest rates are hovering at about 8%. So not sure exactly what's going on, but there's been some fluctuation in the last few years. So when you look into the actual buckets of enterprise value that GF Data reports, the data is pretty interesting in terms of valuation. So during this time period from 2021 to 2024, deals in the $10 to $25 million enterprise value range really haven't changed in terms of multiples that much. They've kind of hovered around 6x or 6 times EBITDA, and that's gone up or down just a little bit each year, but nothing really significant in terms of trend. And then from 25 to 50 million in enterprise value, it's kind of the same story. The data hasn't fluctuated that much. There's no real downtrend in valuation as you might expect. And those deals are valued at about 7x EBITDA. And that's, give or take over the last several years, it's sort of hovered in that range. Mm-hmm. Once you get up to sort of the 100 million to the 500 million range, there's far fewer deals in that size range. And so fewer data points. There's a bit more fluctuation, and there's seems to be a little bit of multiple compression over the last few years with the change in the interest rates. So super interesting data from GF Data. We'll be updating this quarterly, and it's super helpful for us to understand the market and to be able to share some of this ahead of time with you.
That was awesome. Thank you, Max. Yeah, thank you to GF Data for the partnership and providing us a first look at some of this data. It's really, really great stuff, and hopefully we can help educate not only ourselves but the market by sharing it. Well, let's turn to the interview. My typical reminder just before we do that Minds Capital is actively investing in independent sponsor deals. So if you are a sponsor with a deal, submit it to us. deal@mindscapital.co. And if you're interested in investing in Minds Capital as an LP, If you go to our website, there is a pre-registration form where you can submit your information as an accredited investor, and we'll add you to the list on news about our future fundraisers, one of which is around the corner. Okay, here is episode 28 of the Minds Capital podcast with Rick Apple of Upside Growth Partners. Enjoy. Welcome to the Minds Capital podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Rick Apple founded Upside Growth Partners in 2020. After a decade-long career in private equity investing and operations, Upside has closed 12 platforms with several exits under their belt. Rick lives in Nashville, where he and his wife are raising their 5 children. His wife, Rachel, teaches at Vanderbilt. She's a physician. Rick, welcome to the Minds Capital podcast.
Hey, guys. Thanks for having me on.
Rick, 5 kids, 12 platforms. What is the secret to always pushing for one more in business and in life?
I don't know that you'll always push for one more in life. We're thrilled with our 5. 2 boys, 3 girls, and it's being a parent's the best thing and the hardest thing. Well, on the business side, it's just what we love to do. My younger sister's an accountant, wealth manager. She asked me 2 years ago, "Hey, Rick, what would you do if you could do anything?" So I think I'd keep doing exactly what we're doing right now. I just enjoy it. I love working with the people we get to work with and helping sort of our founder partners grow their companies and just realize some of the benefits and gains from that, not just on the economic side, but there's a lot of fulfillment that comes in taking something and creating it and playing where we do in small company land on the one hand and the middle market on the other. You get to see a lot of that.
Yeah. Well, if you could do anything in doing exactly what you're doing, I often feel the same way. What a gift it is to feel that way, huh?
Absolutely.
Well, Rick, we have been learning more about your career, and the evolution of Upside is pretty interesting. You all started investing in smaller, growthier, riskier businesses. Today, your typical target is a more kind of conventional target in independent sponsor land. Let's hear about Upside 1.0, Upside 2.0, why and how you evolved.
Yeah, some of it's the maturation of us getting older. But we kind of got into it, from the operator side a little bit. My partner, Eric Stiller, was a management consultant and a baseball player. And I roped him into our first investment when he was getting his MBA at Wharton. And I was running a voice over IP company named Altus. And we partnered with this woman out of Lexington, Kentucky, who had this clothing business called the Beaufort Bonnet Company. And it was something that we both were able to do kind of on the side, put in some of our own money and some of our time and skills. That I'm sort of a finance, business strategy, legal guy. And my partner, Eric, is also like a strategy guy, but much more technical, digital savvy. And so he kind of ran the web platform and the e-commerce engine, and I did some of the finance and legal work. And we just kind of leaned in with time and money. And it just went really well. And so we sold that business. Marquis was a total dynamo. She ran it for 6 years after we sold it. We sold to a public company in 2017. And Eric, moved his family back to Nashville not that long afterwards. And we started Upside. And so we tried to recreate kind of the Beaufort Bonnet experience after that. So we were investing our own money off our own balance sheet, hundreds of thousands of dollars into a transaction at a time, and then getting involved fractionally, whether that was on the finance side or the marketing side or software development side. And some of those companies went really well too. It's just what we found is that from our time standpoint, we could each kind of really only lean into one or two things at a time, right? And so there's sort of a constraint on your ability to invest if the investment always comes with a huge amount of time tied with it. And, along the way, we sort of bumped into first it was called Fundless Sponsor, and then it became Independent Sponsor. This whole ecosystem that existed right sort of above where we were, and right adjacent, I'd worked at a fund here in Nashville called Council Capital that did growth equity, $10, $20 million checks into healthcare IT and healthcare services companies. And we picked up our head and said, oh, this is kind of what we should be doing. We should be taking our money and other people's money and investing in these companies. And so that's kind of how it's changed through the years. We still love really leaning in. We feel like if you get your hands dirty, I was a management consultant, was my first job. He obviously was a management consultant. I ran this voice over IP company with my partner, Brian Jones, who's a career telecom successful executive for 6 years. And we had all the sales function, ops function, and finance back office billing. And so we had been in real companies, but we were very sort of broadly toolkitted. I studied engineering. I did finance in New York. I took the bar exam. I'm not really a specialist at anything, but I did feel like I had a toolkit that could help a lot of sort of smaller entrepreneurs kind of grow their companies. And so we ended up doing that through the years.
And so today, in what you guys call Upside 2.0, you are more conventional independent sponsors. And the types of targets are?
So 10 million of revenue and up, and 2 million of EBITDA and up at point of entry, 10 to 30 million of equity kind of per deal. That could go a little higher, probably not too much lower. We still bump into Upside 1.0 opportunities, but, it's just hard to invest your time on that basis, even in like the more conventional deals. Like we did one last year called Radnor Roofing, where we partnered with an executive to build a residential re-roofing services platform, predominantly in sort of the Southeast and adjacent geographies. We've acquired 2 businesses so far. We have 2 more we're working on right now, and a series of other opportunities right behind those. And we started off with one sort of person we really believed in, and had never run a roofing business. And here we are a year into it, we have an all-star CFO with Big Four and M&A experience, an all-star COO who has 10 years in roofing but is an attorney and brings just a lot of operational expertise to the platform, a controller below the CFO, a marketing. Like we have the whole sort of team built out. But until we had that team all the way built out, Eric and I were playing more heavily fractionalized roles in the business alongside David, the CEO. So we still feel that a key part of the independent sponsor model for us, and I think is something that draws the LPs to it, is the degree of involvement you can get from your sponsor partner. But to us, that feels like a 1 to 2 year, maybe 3 year lift each deal, right? And not necessarily sort of a life of the deal kind of lift.
So if you split that 2 year, or you talk about 2 years of heavy lifting, what does that entail, and how will you contrast that to the back half of the investment period?
Oh yeah, I mean, let's say you buy a private business, you invariably have to put it on accrual accounting if it's not already, right? You have to put in sort of a budgeting process, KPIs, reporting. Sometimes you have to put in the ERP system. So we've put in NetSuite, put in Intact or Sage now. A lot of these businesses aren't quick. We put in SAP, which I wouldn't recommend for most people, is really painful. You have to put in marketing systems, like whether it's Salesforce or HubSpot and tools. So there's a lot of like putting in the technology infrastructure, and then the making sure that you have your growth plan, whether it's a de novo growth plan, like in our ABA business, ICANN, or M&A growth plan, like it is in our Radnor Roofing business. And then importantly, it takes a couple of years sometimes to get the people onto the team that you want. Sometimes you're inheriting some good people, like a good COO or maybe a good controller, but you need to sort of build out the team. And a lot of times the capital we bring enables the business to, for the first time, go hire what I'd call an expensive person, right? It's a little bit easier to go recruit somebody if they think of it as a 3, 5, 7 year run and they get some profits interest or some employee stock options, and they have a pathway to getting a little bit of a bump if they create value for the whole shareholder base. So those 2 years are really about making sure you have the systems, process, infrastructure, and importantly, team members to execute on the growth plan. And then invariably stuff happens. So if you think about sort of the back half of that hold period, it's a more traditional kind of board level role. I mean, maybe you're on a weekly call with the CEO, maybe it's a monthly sit down, but you're evaluating capital needs, requirements, borrowing money or not, M&A opportunities. Should we go to Nebraska or go to Ohio? Those kinds of things. But it's more of a traditional kind of board level role as opposed to, hey, Rick, will you read this managed services agreement and mark it up for me? Which I will do from time to time.
Rick, and so there's been 12 platform acquisitions to date with some exits. So how many are you right now? How many platforms are you in right now?
8.
8. So speaking of scale, that's a lot more than many of the sponsor groups that we talk to.
Right. But it's been about one a year. I mean, our first, after we sold Buford Bonnet in 2017, we sold to Oxford Industries. They own Tommy Bahama, Lilly Pulitzer, Southern Tide, and Buford Bonnet is sort of a preppy Southern vintage children's clothing brand. And it's probably the 4th biggest brand in their portfolio now. After we sold that, we started doing 1 or 2 a year since then. And, a couple of years we did 2, most years we did 1. And so we've had some time to sort of stack them up one on top of the other.
And just before we get too far away from Upside 1.0, I hear you say that scale was the thing that drove you to Upside 2.0 and the model that you have now. But how I would have thought that it would be more the risk reward profile you prefer in the kind of targets that you look at now, bigger businesses, more established businesses, clearer playbooks, versus a Buford Bonnet, which was a nascent or much smaller company by comparison. And you were going to need a much more upside, which I believe you got, to justify that investment. So just talk to us about how you think about the risk reward in these two, kind of growthy nascent businesses versus the more mature, mid-single digit EBITDA businesses that you target today.
Right. So I'd say at first is we don't view ourselves as a venture firm in any respect. Right. And so we're not trying to create the next Facebook or take some model that's totally unproven and go invest in that. And that's something I came away with my council capital days. And I really believe in, does the core business model exist and can you validate that before you invest? And that's still true in the smaller, what I'll call the Upside 1.0 deals and the platforms we're doing here in Upside 2.0. So in Upside 1.0, it was really about subscale businesses, right? Businesses that didn't have a complete management team. They might be near break even, or they didn't have 2 or 3 or 5 of EBITDA. It's sort of the entry points on the services side for traditional businesses that get a lot of investor interest, a lot of eyeballs, and so. Or in software land, it might be less than 10 million of ARR. A lot of software businesses you try and run near break even if you have a good CAC to LTV ratio. And so we would absolutely be looking for opportunities where we felt like, oh man, we have a clear path to a 10 to 20x MOIC if this goes well, right? It just
10 to 20x.
If you're going to spend the time to do it, and you're investing a more modest amount of money, you kind of need a higher return to justify the time.
Sure.
But
Sure.
We would never characterize those as venture-y, but because of their size and stage and profile, they were more risky for sure.
Right.
The best thing about moving to like a more established, more mature business, so I'd call that above 10 in ARR for software or above 2 in EBITDA, which is still below the cutoff for a lot of middle market investment groups, is that you can afford better people faster, right? And so you can get more capital into the deal, first off, and then you can afford better people faster. And so even if you get, we want to see a very clear path to a 5x MOIC and a potentiality to a 7x on sort of our deals. And then like a downside, do we have an extremely credible case at a 3x, right? It's like if you're hitting 3x's all day long, you're going to be able to stay in business, right? But we really want that path to 5 and 7. You can generate plenty of dollars of return to take care of your investors, the management team, and the GP.
That 3, 5, and 7 MOIC that you mentioned, 3 conservatively, clear path to 5, and 7 at the as a great outcome. Do you feel like most sponsors have a similar kind of MOIC goals?
I mean, I think they kind of have to. I think as you go up market, you'll see the funds often underwrite to sort of 2.5 to 3.5 probably. But I think where we're playing, you call that 2 to 15 of EBITDA or 2 to 10 at entry, a lot of people are targeting those numbers. I don't have unbelievable visibility on what other people are achieving, right? But that's definitely, I think, the model. And the LPs, are there for a reason. And this model isn't as new as it was 10 years ago.
Mm-hmm.
Across 12 platforms of which you've exited 4, does that range of outcomes resonate with you?
Yeah, I think it does. Yeah.
Mm-hmm.
And based on what you know from other sponsors, do you think it's because these are, I should say, pro forma projections on the front end of a deal, but do you see that on average sponsor deals fall in this range?
I mean, when you're having coffee with your friends and you're at the shows and the conferences and you're talking to the intermediaries, yes. But I think the devil's in the details. And so I can't answer that as clearly, even if you'd like me to like. I only have so much information. But I'm certain, talking to the LPs who frequent these markets, that they're seeing higher returns over longer periods of time in this part of the lower middle market, right? They've told me that in these kinds of deals. Otherwise, they wouldn't be doing it. Because it's smaller checks, it's a little bit harder to underwrite. I think they like the risk reward trade off.
And what's the link between the smaller checks and higher returns?
In the sense of what?
Well, you can look at your own deals too. You say that the small ones need to have a higher return potential.
Right.
And then you say large cap, they rarely get 5x MOIC because the platforms are so big. So can you just walk us through? I mean, I guess it's mathematics.
It's just math, because at the end of the day, people want cash on cash returns, right? You can't eat IRR. You can't really eat MOIC. So if just say $1 million, if you turn $1 million into $5 million, great, right? But if you turn 20 million into 60 million, that's way better, right?
Rick, you mentioned your roofing deal, and you mentioned that you actually had your executive, your operator, first, and then went looking. And this is something. This is a pattern at Upside, is it not? Something that you like to do.
It's one of our.
Talk to us about that, please.
For sure. So we're generalists. When I was an investment banker, I covered industrials. When I was a management consultant, I worked with financial services companies. When I worked in private equity, I worked with healthcare companies. The company I ran was a voice over IP telecom business. I've invested in a lot of software businesses. We're generalists. I think a great way to invest is knowing a market really well, right? And you're the fintech guy or you're the oil and gas guy or pick your end market and get in there, know it really well. Behavioral health. We're not those people, right? And so we want to partner with people who do have visibility into markets, experience, networks, and we feel that a lot of our partners are first-time CEOs, right? So they want help, getting in and getting after the market. They believe in their ability. They believe in their toolkit, but they don't have a bunch of exits, to back on. And so they really want a partner who will be invested operationally, as we alluded to, Nicholas, with the sort of the way we dive in. And so at any point in time, we have call it 1 to 3 people, potential operators with whom we're studying end markets and verticals and trying to turn over rocks and do some direct sourcing and some intermediary-based sourcing in those end markets. And probably about half of our deals, maybe over the past 4 years, have come from that channel. We just feel like, by the time you've looked at 50 roofing companies, when you look at the 51st, you know what your buy box is. And so our first acquisition in the roofing platform is a good company. It was well run by a family. And, it got listed by a business broker, and we put it under LOI the same day.
And with these operating partners that you're working with, kind of have on standby, you're searching alongside them. The model is that they come from their industry with a thesis about their industry and pitch you guys on that industry.
Both, and it gets all over the map. So sometimes they're coming out of the industry and they go back into the industry, or sometimes, one of them was an investment banker. We've worked with management consultants, but they're people that have high degrees of integrity. That's like our first. Does this person have character? Are they going to be a good partner in good times and bad? And then do they have a work ethic? You have to be willing to work, because being an operator is extremely burdensome. And at times it can be lonely and you can feel trapped. When you're an investor or consultant, you often will work on a few things at one point in time. And so the worst parts of any one company's situation, you can kind of set aside and then come back to later. When you're the CEO or the COO, you have to live it nonstop, and you don't get to take that problem and put it down. But to your point, our operator partners, sometimes they come from industry, sometimes they don't. David Zickler, he's our partner in the roofing business. We were looking at a different end market with him for a year, sort of industrial and safety product distribution businesses. And it wasn't full time. It was just from time to time. We'd send him stuff, he'd send us stuff, and we'd talk and get coffee or get a meal. And then, he had his job, and we had our portfolio. But then when we got, spun up on roofing, we started talking every week or every month about different opportunities, and visited a number of businesses before we acquired our first one. So it's a generalist that gave us like a lot more conviction when we finally, made our first acquisition.
Yeah. And do these individuals come to you and pitch themselves and say, let's do something together? I'm just trying to tease out any difference between the kind of the typical operating partner model that many private equity shops will have. Is it basically that, or is it more like folks come to you, pitch you, and say, I'd like to go from being an employee to running something, and I know you guys do this, let's work together?
It's been everything, but that has happened.
Okay.
Again, it's like the quality of the person is the biggest thing. And do you want to be through something that could go well or could be a challenge with this person? Because it's like getting married. It's going to take years. 3, 5, 7, 10 years. It's a big partnership. And so you want to enjoy spending time with them. One of the great things about working with Eric Stillers, he and I were college friends at Princeton before we'd met our wives, before we had any jobs, before I really knew what private equity was. We were friends. And so we always had that sort of relationship and trust to fall back on if something's, hits us out of left field that we weren't planning for.
Yeah.
How do you evaluate new prospective operators coming in the door in terms of integrity and quality that are so important?
A lot of it is, are they trusted by people that you trust? So, I found that one of the great ways to hire people is to hire people who've worked for your friends or colleagues or people in your network, right? So if you work with someone, it's like being a sibling of someone. You know what their level is, right? When I worked my first job, Oliver Wyman, New York Consulting, I worked with a lot of really brilliant, really kind, really fun, thoughtful people, many of whom I'd happily work with again, right? And it only took a year in the trenches or 2 years in the trenches or one project with some of these people who've gone on to do all sorts of things, where you could tell, oh man, I can really trust this person to do. And so there are people who recommend, hey, go grab a meeting with this person. They did this. You should meet them, and here's why. I mean, that's how I met my partner in the telecom business. I had 2 different friends say, I need to go meet Brian. And Brian had been successful already. He was a few years older than me, for sure. And he was the guy, but he had this vision around us. It's just a cloud-based VoIP business. At this point, like phone systems were going from on-premise and PSTN to over IP and in the cloud. And he'd been in telecom his whole career and wanted to build one of them. And he wanted a partner to do that with. And So he started this business, and then he brought me over. But I got to know him from two different people who said, "Hey, go meet with Brian." But that, so I think
it's reputation. It's really
reputation and integrity goes with that, right? Integrity and capability and desire to work hard and compete. The market's competitive. It's getting more competitive. That's true in investing. It's true in a lot of things. And so you have to want to compete.
Rick, one of the lines we heard you say, which grabbed the attention of both me and Nicholas in our pre-call, was that everybody wants to be an operator.
Oh yeah.
You said it in passing, but our ears perked up because we thought that everybody wants to be in your seat, wants to be an investor, and as you said, be able to put aside, first of all, be doing a bunch of different things at once, but importantly, be able to put aside, the really hard stuff, and work on the next thing. So what did you mean?
I kind of feel like I meant that everyone thinks they could be a good operator, right? So people, especially men, are very self-confident, right? And especially, we went to Princeton and Vanderbilt, and he went to Wharton, and we worked in New York and BCG, and he worked at Google. And, these people are self-confident for a reason, and everyone thinks that they can run a company. But when you're running a company, even if you're not the guy, if you're a vice president of some division, you realize how much there is to do, how imperfect your information is, how constrained you are by your geography or your supplier relationship or team members you can't change, or there's a whole litany of things. And it's not like some MBA case study, right? You go to business school and you do this 3-hour case study and it has an answer or a series of answers and perspectives, but it's always so clean. And the real world's not clean at all. And when you're operating, you have to live in that. So I think what I would have meant is that most people think that they can operate. And a lot of people want to operate and for good reasons, because they want to lead teams and they want to set a vision and have a positive impact in their market or their community or a great place to work for their employees. There's a lot of good reasons to do it. But I think there's a little bit more everyone thinks they can do it than everyone wants to do it.
I actually recall it differently from our pre-call. I think you were contrasting it to sitting on Wall Street working for large cap private equity. And you were saying all of those guys want to be operators. And by that, they mean closer to the action like an independent sponsor.
Well, so that's, I totally believe that. I talk to a lot of friends regularly who used to work in New York, and everyone says, "Oh, I'm going to go buy an HVAC business or a plumbing business," because it sounds so easy. Oh, I'm just going to go buy a plumbing business. I'll pay 6 times, right? 7 times maybe, and it'll create some good cash flow, and then I'll just grow it. Do some add-ons, and of course, it's not that easy. It's way harder. But I think when you're up there, there's a lot of the way we, and I'm guilty of it, we talked about, we bought this business, we paid 8 times, 12 times, put some debt on, this is our plan. But of course, we were the analysts and associates working for the MDs, just advising the management team who was getting money from, we were so far removed from actually doing anything in the business that it was just a little bit of, I feel like, intellectual conceit. That kind of rubs me the wrong way.
So you say it's not that easy, but earlier in the conversation, you also suggested that the base case must show 5 times MOIC. So
right. That's why it's hard.
How can you reconcile these things?
That's why you have to look at several hundred things and maybe do one. It's extremely hard. I think it's very hard. I don't think it's easy to reconcile. Most businesses, if you go by some of the data, it's 80% of companies fail, or a lot of that stuff's true. I think it's really hard. We had a business, Honey and Hank. We tried to recreate the Beaufort Bonnet Company outcome. We started a home goods brand from scratch, and we had a fantastic partner in the business. Her name's Jenny Smiley. We've worked with a series of women through the years that I just really admire. And we got it up to several $1 million of revenue, and it was making a few $100K. But Jenny and the team were working incredibly hard, and the money was going back onto the balance sheet and inventory and purchasing. And working capital, and we couldn't get it anywhere. If you can't get it to 10, 20, 30 million top line, we just didn't feel like there was any pathway. So we ended up, unwinding it, and thankfully we got our money out. The money was on the balance sheet and moved on. But, there we had great people, great team, lots of integrity, super hardworking, and we still couldn't make it go.
So can you contrast Beaufort Bonnet? It's huge success with that. What was the difference?
Beaufort Bonnet had a really unique aesthetic. Marky sort of, has an eye for those things. And we had great margins in that business. A majority of that business was direct to consumer, online, e-commerce, had a pretty meaningful wholesale component, but we kind of viewed the wholesale like selling into 400, 500, 600 retail outlets, children's clothing boutiques, as almost like marketing spend to fund the other part of the business. And then, we in Beaufort Bonnet land hit the Instagram advertise. So advertising has evolved a lot over the past 10 or 15 years. And there was a time in Instagram's evolution where you could just, basically advertise for free by posting pictures in people's feeds. And you can get pictures into people's feeds. And, Marky and the team had great photography. I mean, one summer we went to my in-laws' home in Hilton Head, South Carolina. And I brought my 1-year-old son, Dean. He's now 12. And everyone brought one of their children, and we hired a photographer and took pictures of the children up and down in Sea Pines and, in Beaufort, South Carolina. And so we had all this great content, right, of our own kids in this stuff, but that created an impulse to buy and it had great margins. So, whereas in home goods land, so few contracts, you're only going to buy so many sets of pillows or napkins or towels or tablecloths. Your children grow. And if you monogram something, it's harder to give away or pass down. And the impulse for a grandmother to purchase a cute outfit for her grandchild is very strong. And so if it's $50, $100, $200 for an outfit or two, they just ring that cash register, and they should. I mean, there's nothing more rich than getting to spend time, holidays, any day with your family. And so childhood's a special time, and Marky and the team really sold into that really well.
I can't tell you how many times I've heard that a business be successful because they were on some platform, be it one of the big socials or even Google in the early days, when the cost per click was just really cheap, or the feed, what you posted in your own feed for free, it still traveled. You didn't have to pay for play. And that being there for that window of that moment in time was the difference. If they had launched 3 years later and tried to advertise on whatever platform they'd been advertising on, the entire cost structure of the business wouldn't have worked or worked as well.
Yeah, I certainly wouldn't pin it all on that, but that was one component. I think the design, we had a lot of custom prints, right? So at first it was like seersucker John Johns and patterns that were more easy for others to copy. At one point, Mud Pie copied our bonnet. Theirs was $20 or $25. Ours was $50 or $60. Ours had better construction, it's higher quality materials, but theirs kind of did totally rip off Marky's bonnet design. And once we got the patterns, a pattern is copyrightable. It's an original creative expression. It's artwork, and it's not easy to copy. Right? It's hard. And the way we got that was, and this, Marky called up Tom Chubb, who's the CEO of Oxford, and explained, we probably were a couple $1 million in revenue. So we weren't some big company. He'd never heard of us. And he invited us down to Atlanta. We told him about the business, and he said, hey, well, we'll help you produce stuff. We'll do your polos for the little boys, and we'll connect you with our swimwear people, and we'll connect you with some creative people who do original artwork. Because, if you think of someone like Lily Pulitzer, they have all of this art every year that defines their print and their sort of look and feel. And so Marky ran with that and took her aesthetic and overlaid it on our children's product. And it worked really well. It really differentiated us. So I think there's a lot about that worked. But being on Instagram when it was free certainly didn't hurt. And you're
Didn't
right.
hurt.
Like, I've read a lot of these books about companies that were at the right place at the right time from a customer acquisition standpoint.
Yeah. Yeah. Another thing, Rick, that we have talked about offline is female operators. You've worked with more than your fair share. Independent sponsor land is dominated by non-females.
Yeah. You go to one of these like trade shows, and it's a bunch of middle-aged guys in blue blazers. It almost makes me sick, even though I'm one of them. But sometimes I don't wear a blazer. No, we totally believe that there's pockets of, certainly female operators. When I was at Council Capital, I got to work with Judy Bishop, who's a big home health, home care executive, and she had been an operator, and then she was building a software business that we invested in. She did a fantastic job. I got to work with Jenna Lodge, who had been secretary for Governor Bredesen here in Tennessee. She ran like human services for the state, but then we put her into a distribution and logistics business, and she was CEO of that business. So she and I came into that sort of at the same time. So I got to know her. I saw her yesterday down at Ellison Soda Shop. And then obviously you heard me talk about Marky and Jenny, and we just feel like we've worked with a lot of women who have different skills to the ones we have.
Like what?
Well, I mean, Marky's obviously a designer and a creative and she's selling, and she's great at building her team and getting the right people to work. When we were negotiating our purchase agreement when we sold the company, she understood the price, right? What are they going to pay? But we're talking about indemnification provisions and governance rights and all this stuff. That wasn't her lingua franca, and so having me around the table didn't hurt. Or when we got some financing and lending and capital along the way, and we were able to do that. Or Eric, right? When we invested, there was a website that had been built by an individual at some regional agency somewhere, and Eric Stiller was again at Wharton, and I think for one of his classes, his project was to re-platform Beaver Bonnet's e-commerce, right? And so we basically told Eric, go figure out what the best platform is in e-commerce, okay? And we're gonna build a Beaver Bonnet website on it, okay? So Marky couldn't have done that. I couldn't do that. Eric could, and he studied, it was Magento, BigCommerce, and Shopify, and he said Shopify is going to win for these 6 reasons. He also told that to some of his hedge fund friends in New York who made a killing on it, and they did all their research, that they earned what they made. But Shopify was great and has been a great partner and is the gorilla in that space. And the day we turned on the Shopify site, our average order per transaction, or dollar value or doubled, because on the old platform it was very difficult to add more than one thing to the cart, right?
Yeah.
And so Eric had this skill set that we didn't have, she didn't have, and so matched together. Same thing, some attorneys, finance, and that's been true in different ways in different businesses. It's not always true that it breaks on gender, but we just feel like women is gross, as compared to our contemporaries from New York and business school, they have a really nice mix of sort of ambition, confidence, but also humility, willingness to learn, willingness to share. And that just makes a really good partnership.
Yeah.
So why don't we see more females at the independent sponsor conferences?
Well, I don't know, Nicholas. They don't go to the banks and PE groups, which are the traditional ways in to the community, right? When I was an investment banking analyst, we had one female analyst who was my class, and no VPs or associates or managing directors. And they kept trying to hire them, and they kept quitting for various reasons. It could have been caused by the men, I don't know, but it wasn't because the institution felt like, we don't need, it was just hard because we were working hard and it was taxing. I think it's hard to find balance in life. I I think it's hard. I mean, we talked a little bit about
certainly
that.
Hard driving, all hours consuming finance careers are not hospitable to women when they become mothers. And of course, they have to bear the brunt of that time-wise. We don't. That can, as we well know, that can completely interrupt the career trajectory of women.
Yeah, for sure.
So,
and, that's true in other disciplines too. Rachel and I have made it work because we have, so much support. She's a physician, my wife's a physician, and we have a lot of family support, community support. We have a nanny who's been fantastic. So there's a lot of hands helping us. My in-laws live down the street and they do pick up from school every single day and take them to tennis and golf or gymnastics or whatever's going on.
What did the early successes mean for you and Upside?
I think it just gave us confidence that we could source and execute and help these businesses. We've sold to PE groups, we've sold to strategics, we sold to this public company, this one deal. And I think it made us want to do more of it, and it gave us some autonomy, right? When you own your own business, you probably end up working harder than if you don't, right? That's my contention mostly, but you can control your schedule some of the time. And that autonomy is really important. So you can often choose, which projects do you take on? Who do you work with? And if you need to cancel a meeting or a call, if something happens and one of my children, their school's a few blocks away from our office in Green Hills. If something needs to happen, I usually can bow out of whatever it is and get over there and help. And so that autonomy and control that you have is, I'd say as a business owner in general, is really something that we got from some of these early successes.
Was that something that compelled you about being an independent sponsor, that it has that more autonomous, flexible lifestyle?
Oh, for sure. Yeah. I mean, there's some things about the fund, namely the stability of the management fee when you raise it on a 3, 5, 7-year cycle, right? So that gives you all this stability, but we don't necessarily want the pressure to deploy that creates. It creates a bunch of, you have to have more people, right? If you're going to deploy more capital faster, you have to have a bigger team, which is its own set of challenges and problems. And then the regulatory overhang, because each deal, we're not registered as an investment advisor with the FCC the way that a lot of these funds will once they cross certain thresholds. Each company stands alone. And we love telling the story of why we think this is a good idea. And our LPs enjoy, I think, getting to be in the roofing deal, but not the autism services deal or some other deal. Because of whatever reason.
So what it sounds like is you started your own business just like a regular business owner. You're an entrepreneur. And because of early success, you got it to a point where now you're enjoying and reaping the benefits of that as you choreograph the rest of your life. And then you happen to really enjoy what you're doing. So that's the icing on the cake, which is why you can continue to push for more deals. But you really facilitated this through entrepreneurship.
Oh, I really believe in entrepreneurship. Yeah. And I do feel like I was fortunate. I would say that every good thing that's happened to me in business has been largely due to my partners, right? You've heard me talk about Marquis. Brian Jones is a partner in the telecom. Certainly Eric Stiller here has been my foremost partner, but we have a lot of people who we've worked with multiple times now, right? The finance guy, Travis Comedian, in the telecom deal, I was like, hey, let's do the autism deal together. And so he came over and did that with me. And there's a series of people who we've worked with multiple times. And that's really rewarding. But it does definitely compound. And I think the hardest thing from the outside when you're thinking about becoming an independent sponsor is, well, where do I start, right? How do I do my first deal? And by the time we even started doing it, we'd already done our first deals, and I had already gotten to live at Council Capital and do 8 or 10 deals there. So I kind of knew what I needed to know from a deal toolkit experiential standpoint.
Talk more about what you mean about compounding in this context.
if you have some early successes, okay, that makes it easier to open doors to get in front of the right kind of opportunities for the next one. It gives you more capital to deploy into the next one, okay? It gives you more capital to be patient for the right kind of opportunity while you have a family and everyone has to live their life. So I think that getting some early, it's just like compounding, like, you know, getting early wins on the board makes it way easier for 10 years down the road in multiple respects. It's easier to get meetings with the right people. Eric and I have both benefited from going to Princeton. You know, we have lots of lifelong friends from Princeton, but that has, especially when we were younger, like opened doors for us where we can get in front of, well, obviously this person's at least okay at something.
Yeah.
That dissipates over time. Where you went to college dissipates as you get, it's more like, well, what have you done? But it's the same kind of thing. It opens some doors. Like I got to go work on Wall Street, and if I'd gone to, you know, some places that wouldn't have been an option.
Yeah.
I was asked yesterday by someone, how do you create deal flow, or how do you get deals coming your way? How do you get inbounds? And I said exactly what you said there. It's a little bit of a compounding effect. When you're on day one, nobody on your LinkedIn or in your network will know that you're doing this or what you're looking for or associate you with these kind of situations.
Right.
Versus when you're so many years into it as you are, and especially when you can espouse such success that you have, you get more and more people who will think about you whenever they come, you know, accountants or wealth managers or just people in your network who will think about you whenever they hear about Mr. Joe, who is 73 and wants to exit.
And so I'll tell you, Nicholas, like almost every meeting I have with a friend or someone, if they say, well, what can I do for you? I say, well, if you know of a family business that, you know, has at least $1 million or $2 million of profit that they're not sure what to do with, you know, and they're going to want to entertain a conversation or think about, I would love to meet them. So I tell that to people, told it to my friends yesterday over lunch, told to someone the day before. And that hasn't created many opportunities, but it creates some, right? The other thing I'd say on sourcing is the more discreet you can be about, I want roofing companies, or I'm trying to roll up doggy daycares, the more likely it is to get it. The more general you are, I want a $3 million, $7 million EBITDA business with a management team who's going to stick around and a moat. Like that doesn't mean anything to anyone. Everyone wants that business.
No, that's right. You surprised me on our pre-call when you said that a high amount of the opportunities that you end up doing are deals that you bumped into.
Yes, I said
versus
half.
half. Versus the other half was thesis driven.
Yeah.
This sounded not very strategic and a little random and lucky, if you want, but is it connected here to the compounding effect?
Yes, it's what you just said. As soon as you're on the field, a ball might bounce your way, or you'll get a shot. You have to be in the mix, and then you never know what's going to come off the wall. And a lot of the best opportunities come not necessarily, like when you're playing in the lower middle market or even small company land, upside 1.0, you don't need a $7 billion end market, right? You can make a great business in a $300 million end market if you own some big piece of it, right? And so a lot of the businesses you've never even thought of, right? That this company exists. And when you go around independent sponsor land, that rings true. Like you look at the deals some of these people doing, you're like, I had no idea that company even existed, right?
And meanwhile, it's throwing off $10 million a year.
Right. And no one's coming out of Stanford Business School or Harvard trying to source the next one of those. We made it a run at a particular healthcare compliance services company earlier this year. We didn't get it, but we loved it. And they basically were the only person doing what they're doing. And it wasn't some gigantic market, but it was a great little family business. You know,
Rick, on this point about time in game or compounding or flywheel, all of these kind of hit on the same theme, momentum. I imagine for a sponsor, especially one who's had some real successes, that capital is the biggest unlock of all, that you can just, once you've generated returns for investors, they're friends for life, and you can keep bringing them deals, and it becomes really easy to raise.
So we think of our capital in terms of like angels, high net worth,
Angels.
There's 6-figure people. There's institutions, 8-figure people. Okay. And then the family offices are the 7-figure people. Right. And so that's kind of how we break it up. Certain deals, you just can only work with institutional people, like our roofing deal. And a lot of the things we're targeting, there's no amount of clubbing together angel dollars to do a $30 million equity. It's just not, worth the time administratively. Although even in our roofing deal, we had a slug that we sort of reserved and got some of our repeat angel investors into alongside the institutional investors.
And was that just out of loyalty to those folks? Like why carve that out?
I mean, yes. And also, felt like, well, could we use another 5 million? Yeah. Yeah, we could. Like, we can definitely put it to good work. And the underwriting's already been done by us and our institutional LPs. The capital raising, now, at first, a lot of it was our own money. And then we haven't lived through, 2020, 2021 was a thing. And then this 08, 09 was the last real economic pinch. A lot of funds are having trouble raising their new funds, but equities are still at all-time highs. So maybe we'll get some of the old stuff out of the portfolio and enable the LPs to recycle capital and funds to raise. We've not had to live through, what I'm saying is, a hard fundraising environment yet, right? So I can't answer the question of what it's going to look like once, the market's down 40% for some amount of time and people feel poor and there's a recession, because we've never had to raise money in that environment. If you think about sourcing the deal, running the company, and raising the money as 3 things we do at Upside, raising the money is by far the least amount of time. And I don't want to use the word easy, because I think that I just don't like counting your chickens before. But it has been less hard than the other two.
And easier over time, certainly.
Yes, and it is true that if people... if you make a return for someone, they're extremely likely to invest again and recommend it to their friends.
Yeah.
You talk about the 3 different types. There are 6-figure high net worth individuals, 7-figure family offices, and 8-figure institutionals.
Yeah.
When and how do you approach them? How do they behave differently for someone who's new to fundraising or coming up on their 2nd or 3rd deal now and they need more equity? Can you just educate the market a little bit?
As you would not be surprised, the family offices and institutions are going to push you harder on terms at times, not always, right? Whereas a lot of the angels are going to be price takers. You're in or you're out, right? Because you can't negotiate with 10 different angels or what have you. Getting it from, institutions can be more efficient. I would say that the institutional piece we worked with understand the game, right? They understand what we're doing, how we're spending our time, and they're really good partners. So they as compared to a family office in particular, they can turn around and answer, we probably like this, or here's our 3 concern points. They're very responsive because they know they also operate on time frames. The family offices are kind of like a unique little nugget because, it depends. Are you talking to the family member or a gatekeeper, right? Sometimes those people have different incentives. Sometimes they can't make a decision on a time frame that works for you. You have 3 months, 90 days to do a deal, or maybe 60 days if it's really tight. And, the family member's not around, right? They're traveling or they're not there. So I kind of find the family offices to be sort of you met one family office, And some of them have very defined processes, and some of them really, really kind of don't. So they're kind of all over the map. But the institutions in general know the game, may push you harder, right? And the angels, think it's fun. Okay, so one of the reasons the angel do it is because they already have their S&P 500, they've got their CFP or their broker, and they think it's fun, right? That's certainly true.
Bragging rights to be in a private business sort of thing.
Yes. Now you owe it to them to make the money, right?
Sure,
but
that's not really what they're.
But that's but part of the reason they do it is they think it's fun or exclusive. That's part of the reason.
And when you say six figure, that's a broad range. Are we talking 100,000, 900,000?
It is a range, but I'd say most of it's in the 100 to 500 or 100 to 300 even range. Because, I think even for a wealthy person, they can imagine, it's illiquid. We're committed to getting you liquid, but it's risky and it's illiquid, right? And so I think they can imagine losing 100 or 200K sometimes and that not really affecting their life. But like, as you go 200, 300, 400, 500, that's a lot of money for almost everybody. Not everybody, but almost everybody.
Yeah.
College education, down payment on house, it's a lot of money.
Yeah.
If you're in the middle of a fundraise and you need more equity, how do you find that next investor?
That hasn't happened to us yet, Nicholas. I mean, candidly, we have a list of many hundreds of angels and then family offices, institutions. We develop relationships. We're now 20 years into our careers. And most of the people on the list we've never shown anything to. So.
And this is an active database that you maintain?
Yeah. So if you're going to raise money, you kind of got to build a list of prospective investors. Yes. And arrange, because different investors, they write different size checks, different industries, different time horizons, different governance, it's all over the map. And so you need some way to catalog that and organize it. And then anyone you really want to work with, the best thing to do is get to know them personally, right? So that they trust you. And so when I call you up, Nicholas, say, hey, Nicholas, I'm doing this doggy daycare roll-up, right? And I've got the first one under LOI. I've got this woman, she's going to come run it. She's fantastic. You already know who I am. And I don't have to get over the hump of, do you trust Rick? I just have to get over the hump of, do you want to do the deal?
Yeah.
I appreciate how you bring up the doggy daycare as an example, because as you know, Minds Capital invested in one of those right down the street from you.
Well, that's a good reason to invest in Minds Capital, because it is a good business.
Changing topics a little bit, you've been in private equity for a long time. You've had 4 exits as a sponsor after that, and you exited many times. Do you always run a process when you want to exit one of your deals?
No. One of the ones we exited from the upside side, there was a institutional PE group that had missed on a company in the same industry. They'd finished second or third. And I had a friend who had a good relationship with them. And we basically built out the data room and said, you guys have 30 days to make us an offer. This is the number. And the group came in and basically hit the number. Or we'll run a process. That was the threat. But in general, if you're a founder owner, you get to decide why to sell. Does the legacy of your family business matter, right? You don't have to go for highest and best price. For me, as a fiduciary, right, I really do have to be very cognizant of price, in my opinion, from my LP standpoint. But I certainly don't think you always have to run a process. There's lots of good reasons not to. But if I'm giving advice in general, I'd say absolutely run a process. Yes. I think that's, in most cases, going to get you a higher outcome, but you have to show everybody your info.
And would that be the same if you have a more troubled asset versus a really, really strongly performing asset? You always run a process?
No, trouble is I think I would probably be a little bit more picky, choosy about that. But it just depends on the asset, Nicholas. It's hard to answer in the abstract. But no, if the question is always a process or not always, I'd say not always. But in general, absolutely.
And so you retain a sell-side banker. What are some of the things you've learned signing up a sell-side banker? What do you look for? What are the key criteria when you pick one?
You just want someone who knows the market and can get you in front of the likely buyer universe and is going to advocate and push for you. A lot of people you've interacted with on different sides of transactions through the years, and so you kind of know them. Sometimes you already know who the buyers are. One of our companies, when I was at Council Capital, we had a therapy EMR named Redoc, and we basically had been approached by a sponsor-backed larger company, Net Health, and we hired a banker basically to keep them honest, right? So that sometimes a banker can say things that you wouldn't want to say to someone you're going to have to work with, or push harder.
And what
You're
do you,
bad cop.
Bad cop. That's the right way to put it.
and what do you typically pay a banker, a sell-side banker?
It just depends on the size of it. It could be a point or two of EV, or it could be in business broker land. I've seen people charge exorbitant amounts. Not that we've paid, but we've bought from when you see the funds flow.
Right, like 6-8%.
Or worse.
Right, wow, worse.
I've seen it up to, beyond that.
Maybe you should acquire a business broker next.
I've thought about that. Well, there's a lot of, the thing about that business is it doesn't take a lot of capital to get in that business. It's a relational business, and can you get the sell side engagements? And there's a lot of, we 1, 3, 5 man bands who do buy side advisory, some on a retainer, some on contingency. We've worked with those different groups through the years, and some of them we really admire, and others maybe not as much. But there's a lot of people in that pocket of the market, and it's a good business model, especially if you're in a big enough end market.
And so you've exited to strategics, even went to a public one time. You've exited to financial buyers. How would you distinguish the various exit avenues, and how do they differ when you deal with them in an exit process?
Well, I think the most down the middle is the financial buyer, the PE group. You kind of know what their perspective is, what they're worried about, why they're asking what they're asking. And then we had just the one rep on the public exit, and they basically ran the business as a standalone business unit in their family of brands. So our team had better benefits and better 401k, and we immediately had more access to working capital lines at cheap prices and different things. And so there were some real pickups there, and they did everything they said they were going to do. And the business flourished sort of in their ecosystem. And, our team, we have a digital commerce company that kind of grew out of that, still managed the e-commerce until, 3-6 months ago. So we've sort of followed that one for a long time. And then the more nuanced one is the strategic buyer, right? Because you have all the investment bank, we call them social issues, right? Who stays, who goes, who's the synergy, right? Is it a cross sell, or is it we're selling the same thing? So the devil's, again, that could look like almost anything. Is it a new market entry? Is it somebody trying to get to access to a geography or a customer base? So there's a whole different range of reasons why they're buying. The best cases, like those people can pay the most, right? Because it's worth way more to them than it would be to anyone else. And this compliance services deal we didn't get, I think went to a PE-backed strategic, and there's going to be some nice cross-sell and probably some multiple arbitrage because the buyers trades at this, and this will trade for something below that, and so they'll get some pickup from the EBITDA, and they're a better natural buyer. So the thing I would say is, if you find the right strategic, they often can pay the best price, and that's true if they're public or private, because of the synergy or the multiple arbitrage that's just baked in.
Rick, anything that we haven't hit on that you wanted to make sure we did?
I'm not sure. It's been fun talking to you guys. I love how this pocket of the market, when we first went to McGuire Woods, is one of the trade shows, conferences people go to, there were probably 600 or 800 people there, kind of half and half, sponsors and now it's like double that or more than triple that. And it's grown a lot, and there are a lot of smart people on both sides of the table, and a lot of people who probably are a little green on both sides of the table, but it's definitely grown a lot. Deal terms to me have coalesced a lot. There's some sort of pretty defined ranges on where carry or management fee, everything should fall. And so you definitely see just this disintermediation of the fund model, and people out turning over rocks looking for these middle market businesses. It feels to me like it's getting more competitive, even at the bottom end of the middle market or the top end of small company land. So you talk about a business with 2 of EBITDA, which used to be kind of like below the radar, and now it gets more attention. There are more of these, you said the broker, like the 2-man bands calling on these businesses, trying to identify them, get them signed up, get them sold, take a fee along the way. It just feels like it's becoming more and more efficient in a lot of ways. And that's a positive, but that means it's not going to be easy.
Yeah. Will we see you at McGuire Woods in October?
Probably.
Great.
We'll be down there.
We'll be down there. The 14th and 15th, I think it is.
14th and 15th. That we've worked with those guys on that series of transactions. Great team. And so
we're actually doing an offsite for Minds Capital LPs and sponsors the next day. So we will not only be there, we'll be planning kind of an adjacent event on the next day. So we're super excited about it. Yeah. Well, Rick Apple, this has been a fantastic conversation. Thank you for sharing with us all about Upside and its trajectory, how it started and where it is today. We really appreciate it. Thank you for your time.
Thank you, Will. Take care, Nicholas.
Hope you enjoyed that interview. For more like it, subscribe to Meeting Other Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraisers. See you in the next episode.